Hello and a very warm welcome to everyone. I am Shrija Agrawal and you're watching our series Winning with Anti-Fragility. We've had public sector undertakings to be a big part of India's economic development for decades and decades. And the objective was to generate more self-sufficiency with regard to the production of goods and services and maintain India's balance of payments. Being so integral, they ended up being dominant players in key sectors. Yet over time, these PSUs began to experience losses and became fiscal liabilities to the economy rather than assets. This meant that the government had to reconsider their position and transition to a mode of disinvestment. And the reforms of 1991, with Mr. P.V. Narasimha Rao as Prime Minister, privatization became a more familiar stream, and the government could divest some of its holdings in these public sector undertakings. Now, privatization falls under an ideology, and there's a great deal of public discourse associated with it. Margaret Thatcher, UK's first female prime minister, made privatization more renowned to revive the stagnant British economy of that time with market based reforms, which ended up with airlines, railroads, postal services, electric utilities, among other businesses that are valued at about $3.3 trillion being privatized since the 1980s. Now, cut to the pandemic. With major economic disruptions in India and the shuttering of the economy, revenue has shrunk considerably and the country's expenditure has increased. The Union Budget 2021 aimed to create robust competitiveness and ameliorate demand to bring our economy back, and this led to the announcement of the Strategic Disinvestment Policy 2021. This policy is meant to minimize the presence of these public sector undertakings, have more disinvestment, and have a stronger infusion of capital and technology for various programs. Divestment will be happening except for four strategic sectors, which are BFSI, transport, communication, atomic energy, space and defense, and power, petroleum, coal, and minerals. We've had a couple of public sector banks be expedited in the mega privatization drive. Air India is also scheduled for the same soon, and the government's stake in BPCL is being sought out by all major corporations, among others. We missed this year's fiscal target of 2.1 trillion rupees, so all we can do now is to have a look at how we can get to next year's fiscal target of 1.75 trillion rupees. Eisenhower famously said, "In preparing for battle, I have always found that plans are useless, but planning is indispensable." Now, the question really in the room is that would these companies, faced with an overhaul of its public to private treatment, be able to stay robust and anti-fragile in face of such shock and volatility? Is this wave of privatization viable for these companies, and how do we get there? To talk more on this and break it down, please help me welcome a very meaningful panel today. I have with me Cyril Shroff, Managing Partner, Sri Limachan Mangaldas, Santosh Shanki Raman, who heads projects and co-heads National Institutions Group at the law firm, and also please help me welcome Manisha Girotra, CEO Moelis India. It's my sheer pleasure and privilege to welcome all of you. And just taking it further from my opening remarks and how I began, I think it's an interesting idea to get view from all of you as to where we actually are in the economy and why do you think this policy is really significant. The target for this fiscal is the 1.75 lakh crore disbursement target. Chief Economic Advisor Krishnamurthy Subramaniam has expressed confidence that this target will be met. We have had privatization targets in the past, but we have considerably missed the mark for these. How confident should we be thinking about this, keeping in mind how cumbersome implementation can be in order to achieve this target, and a historical precedence to having not met those targets? Why this policy is significant? What is the potential for change if this is implemented? Opening remarks first to you, Mr. Shroff, and down the panel.
Thanks, Shrija, and for that excellent sort of opening. I think you really set the stage very well. First, let me sort of begin with a threshold comment on why we are using anti-fragility and asset monetization in the same sentence. And I think there is a very strong connection between both these ideas. It's a big policy idea for the economy. It has elements of both tried and tested as well as the new and novel. And if you look at the context in which the world and India is at the moment, of just about getting through the pandemic, an idea such as this, if properly implemented, has clearly the potential of anti-fragility. What's the essence of anti-fragility? Anti-fragility is different from mere resilience, where you go through a crisis and come out roughly at the same spot. But in anti-fragility, you actually come out better. That was Taleb's thesis. So if this is implemented properly, I think it can have a transformational impact on the economy in multiple ways. First and foremost, I think from the public and the citizens' point of view, there is a serious possibility of getting far better services. I mean, we've seen what happened to the airports. I think many of us remember the old airports, and when the private sector was brought in, it's there is no comparison in terms of the quality of services that you get, and this will cut across all the asset sectors that have been identified. The second, I think, from the point of view of attracting capital, both strategic as well as sort of institutional and patient capital like pension funds and others. I think this whole genre of assets is a sweet spot for both these kinds of investors. So in terms of sheer inflow of intelligent capital, patient capital, I think this is an absolute bonanza. Then the third part, I think, is really, just from the government's point of view. I don't look at it only like privatization, where you're just trying to use it as a means of balancing the fiscal deficit. This is much more than that, because this is really about creating a long-term partnership with the private sector, both strategically and with the markets, and this can be market changing. So there are several benefits of this. But the important thing is that we have to get it right. There is a very big if, because otherwise it is going to be like a Swayamvar where no grooms show up. And that is where it's going to be very important to get all the hygiene and the thinking, and the most importantly the mindset right. I think a lot of our privatization efforts in the past have had to go through multiple attempts, which effectively reflect a change in mindset. But there has been so much learning, and I think we need to benefit from that learning. You can't let Sir Humphrey win on this. We have to make sure that the government recognizes that the private sector has a certain heartbeat. The private sector considerations are different, and if they recognize that and create a high quality partnership, this can be transformational for India. It has got so much potential. It's not just about 6 lakh crores, it's much more than that.
Okay, thanks for that. I get on to you now, Manisha, just taking it further from what Mr. Shroff just said, that this can be transformational, it is game changer. And he actually alluded to the fact that what Taleb said, that when you're resilient, you just sort of are status quo, there's a crisis that happens, and you come out of it. But when you're anti-fragile, you actually emerge stronger. And the entire asset monetization drive actually has assets and facets to that. But you also said at the same time that we have various lessons to be learned from the past. It should not turn out to be a swamwar where there are no takers. Given your expertise in the deal-making spree and what you have seen over the years, what do you think, is this the correct time to be monetizing assets like this? At a time when there's a new outbreak in India, there is political turmoil, the production bottlenecks, there's geopolitical tension. Is this the right time to monetize these assets? And furthermore, do you think is an appetite out for such large issuances? How sustainable do you really see these returns being?
Thank you. Thanks, Shrija. Thanks for having me on the show. So just if we were to step back, I think as you mentioned, when these state-owned companies were set up, the rationale was very different. There wasn't enough capital formation in the private sector. There was no question of any global capital coming into the country. So there was no other option. If we wanted to give manufacturing a boost, this government had to step in. And they stepped in very well and created world-class companies like ONGC, BPCL, Air India in the old days, etc. I think that model has outlived its existence now, because basically what's happening is that there is a huge amount of global capital that's coming in. Domestic capital is there. The market is large enough for people to want to put in capital here for the long term. So there is no reason for the government to be in the business of business. More importantly, today, as Shrija, you and I have discussed in the past, businesses have to be globally competitive. Things are changing on a daily basis because of technology. The kind of disruption that's happening is making companies non-existent, right? We thought these companies are going to be outliers in their business. Today, they don't exist because of what the digital world and the technology has done to them. Now, if you want to be nimble in that, you need a shareholder who is fully aligned to your priorities, and the business of business is the biggest priority for them. For the government, rightly so, there are a lot of other priorities, more important priorities, regulation, etc., etc. So I think in today's world, you need a shareholder who is entirely focused on the company so that the decisions making can be very fast. And I think that's really the key inhibitor for these companies, because I think what they have, and I'm sure we'll talk about it, what they have in terms of skills, in terms of real estate, in terms of assets, is probably equivalent to any other private sector company. I think where they slow down is just in decision making and the nature of that. And I think once you get them out of those shackles, you'll see these companies operate very well. You've seen a Hindustan Zinc in the past, a Balco in the past, how they're thriving in the private sector hands, IPCL. So I think I firmly believe the timing is right. And the reason I say, Shrita, the timing is right, just to add quickly to what you said the country is in turmoil, etc. I don't think the country is in turmoil. I think the world is in turmoil, right? COVID has thrown the whole world into a state of turmoil. In that turmoil, actually, we are standing out very well. Given what happened to China in the last few months, people are putting more and more capital into India. And we must do deals when the buyer is ready. Typically in the past, we've done deals where the seller is ready, but the buyers are not there. Today, the buyers are there. There is so much liquidity in the market. Monetary policy is benign in the US. So this capital is looking to find its way. And companies of the scale that the government can provide to the market, nobody can provide. And the governance in these companies is great, as we all know. So I personally feel the timing is excellent because India is just looking so strong and robust on the global map.
Thanks for that, Manisha. Yeah, thanks for that, Manisha. Well said. I come to you now, Santosh. We just heard from Manisha, and very categorically, she has said that the timing couldn't have been more perfect for this, and various reasons given that enough liquidity out there. We are seeing a benign interest rate environment in the US. And we are seeing this era of super abundant capital playing out in the private market, especially for technology and consumer internet spaces. Would you also think that the floodgates will open for some of these assets, as Mr. Shroff and Misha both mentioned, that this is a once in a lifetime opportunity and can really be a game changer for the economy? What really is your sense here?
Yeah, 2 points. I think just taking a step back before we talk about the floodgates, why is this so significant? And I think that will give us the root answer to whether the floodgates will open or not. It's significant because of the scale at which we are doing it. I think we should not forget the scale at which we contemplate doing this. 2, for the first time, I think like Mr. Shroff said, this is not just a privatization exercise. We are looking at monetization in the truest sense. Which means for the first time, you're looking beyond contracting, you're looking beyond a concession model. You're looking at multiple methodologies and potentially combined multiple methodologies to bring this. We are considering things like REITs and InvITs. We are considering capital market instruments. We are considering the ability to raise finance as being integral to doing this kind of monetization. Once you realize the scale at which this is being contemplated, it is still, I think, in many ways in the realm of contemplation. It's more a statement of intent with an ideation on methodologies, this policy document, and still needs rigor. But once you see the scale and you see the methodology that is being contemplated, I think it's but natural that we will see investor interest. Over the last 3 years, and Manisha will bear me out, and Mr. Shroff is involved in many of these, we have seen the largest scale of infrastructure M&A we've ever seen in this country. This does not simply mean, private market deals. We are talking about bond market deals. We are talking about InvITs and REITs. We are talking about raising capital from public money, including pension funds and insurance companies. So I think the time is great because you've now come to a point where you realize that monetization is not simply a question of price, but a lot more than that. It goes into governance, it goes into capital, it goes into objectives of operations. All of these are fleshed out from, let's say, 20, 25 years ago when India did its first round of thought process on this. So there, I do think capital will come. different forms of capital will come as we've been, and interest levels will continue to go up.
Okay, different forms of capital to come, and that's an interesting aspect. And I think let's dwell a little further on that. I remember having an interaction with CPPIB folks in India, and their head was here, and they mentioned a very interesting analogy, and they said that we like annuity incomes. It's like buying a house and renting off it. It's interesting. We like that they're long-term strategic institutional investors. In fact, in the deal economy, we also call this the Canadians at the gate right now. There's so much of Canadian pension money also flowing in. So when we talk about all forms of capital being interested, where would you think that most interest will come from? How will they look at the unleashing of this opportunity? And I think it's very important to understand this, that the assets that we monetize would have to be handed to the government after 4 years. So how do you think the private sector would react to such a public-private partnership? And does this really allow us to reimagine the PPP model? And what is really the incentive for private parties / investors to invest in these assets, which toward the end of the tenure of the government monetization will be handed to the government? I'll come on to you, Mr. Shroff, then to Manisha, and then to Santosh. Yeah.
Yeah, so in the early 90s, after the 1991 reforms, we saw one phase of PPP on the concession-based model, the early power projects and then some of the other infrastructure projects. I think what we are seeing now is PPP 2.0. It's based on a different model, and there are so many possibilities over here. So to answer your question of who will this be interesting to, I think all varieties of capital. It's going to be interesting for strategics who want to grow and expand because they're going to see this as a massive opportunity for growth and fundamentally re-rating themselves. That's one. Secondly, I think you're going to see new age infrastructure entrepreneurs. So if you go back to the early 90s, the GVKs and the GMRs, and there were so many who kind of got onto national prominence at that time. I think you're going to see a whole new genre of new age infrastructure entrepreneurs who will probably have learned from the lessons of the last 20 years in terms of again how to look at contracts, how to deal with government, and how to approach the markets. So that's another genre of investors who are going to be extremely interested in this, and there is a pile of them. The third, I think, in terms of just financial investors, whether it's the institutional investors like the CPPIBs and the Brookfields and others, I think that's one variety. And they will definitely, even if they don't come in and take control of by buying the whole asset, they will partner. And there will be a bunch of entrepreneurs who would like to bring them in as financial partners. And then when you talk of the REITs and InvITs model, which Santosh was talking about, it's not just strategic, but I think there is a big opportunity for the financial markets as well. So in that, then you're sort of into the capital markets, and then you're going to get a whole genre of investors who are interested in that asset class as well. And I think whilst we had a bit of a bumpy beginning, I think India now has a very good culture of both REITs and InvITs. There are so many successful examples of this as well. So I think it's like one big buffet where there is interesting food for everyone, depending on what your taste is, and you can there is enough on the menu. And there's a bigger point. I think if you really look back, though I don't think any policy maker will spell it out, is what you are doing now, if this goes ahead properly and with the right mindset, you are effectively reversing all the socialization stuff that happened in the first 10 years after independence. This is actually turning it exactly the other way around, and you're doing that by now going to a market-based economy. This is as clear as possible a movement towards a market-based economy, accessing market capital, private entrepreneurship, relying on market regulatory institutions. That is actually what is happening. But because of the political sensitivities, no policymaker will talk about it. You and I can say it. So that's my take on this.
That's well said. Manisha, I would like to bring you in. Very clearly, sort of laying it out that we are definitely moving towards a market based economy. Huge boost being given to private entrepreneurship. Capital markets will play a huge role. I want to understand from you, given you at the heart of deal making, talking to talking to capital providers and the promoters also from both sides in the classic deal making space. Now, when you have these assets owned by the government, we talked about the opportunities, the timing, the capital providers. My two questions for you. One, Mr. Shroff said this is PPP 2.0. Quick comment on that. It's an interesting comment here. What do you think? How will that really work out, the public private partnership? And second, what really do you think is the role of capital markets? How important the role of capital markets will really be in this entire monetization drive?
Sure, Pooja. I think what Cyril said in terms of PPP 2.0 is a very interesting comment. Basically, what last 10 to 20 years has shown is that it's extremely difficult to set up greenfield assets in India. You know, the time is involved is too long, regulatory processes take long, land acquisition takes long. With the state-owned assets, you actually have a ready-made opportunity, and private sector, which today has probably the lowest levels of leverage that we've seen in the last 10 years, would love to grab this opportunity in the various infrastructure sectors, and just given the state and size of the economy, and grab this opportunity. So I feel very confident that that you will see a lot of private sector participation in the long gestation infrastructure projects, which you probably wouldn't have seen 10 to 20 years ago, just because of the kind of capital involved and the kind of opportunity that exists. And I think what I like, which Cyril and Santosh both alluded to, is the fact that the government is demonstrating flexibility in the process of privatization. There are some which are strategic sales like Air India. There are some which are just, for example, the Axis Bank stake, which just got sold in the public markets because there's enough liquidity. Then, as you mentioned, there'll be some brownfield assets which get leased for a short period. That's great, right? Because you're showing that there are different structures that can be used to get to the end game. There's not one structure which is being prescribed and saying, look, we're going to go down this route, even though that may not be the right route for that asset. For example, in BPCL today, you won't see the large oil and gas majors coming just because the oil and gas majors are being beaten up for their own ESG priorities. So the government has shown nimbleness, and basically you have both. As I understand, you have both financial investors and strategic investors in the process. Really important not to be rigid, not to say we will only have strategic investors in this process. You mentioned CPPIB. The Canadians have so much money. Bring them in the structures they want, whether it's an InvIT, in a REIT, whatever it is. So I think that's what I like the most in the model that's being followed now, that we are showing nimbleness and an awareness of what's happening in the markets. In terms of public markets, I think the public markets are very willing to support this. You saw that in the Axis Bank stake when the government sold it. You'll see it in the other privatizations which the government decides to do. Public market has a lot of liquidity. And today what it's looking for is size and scale. They're not looking to do the smaller, Cyril will tell you, in the times that we all started to do a 200 to 500 crore IPO issue, it was like, daunting task. Today, like, nobody wants 200 to 500 crore IPO issues because people are saying that's the minimum I have to put in a deal, right? And who better than these government companies to offer that opportunity, because the government shareholding is high, the businesses are large. So basically the liquidity opportunity can be very large. And that's what people are looking to do globally. They're looking to write large checks in high quality companies. So I think the public markets will embrace whatever opportunity you give them in the good quality assets. The public market, I don't think things like Air India, etc., will have to go through the strategic route, because that's a very different business model. But the good quality companies, I think the public market will embrace fully.
Shrija, you're on mute.
Yeah. So unanimous voice coming in that there'll be takers, there'll be investors' interest, and all kinds of interest. And I like Manisha's point where she said that the government is showing nimbleness. It is not being rigid. So the question really becomes now that what really should be the mental modes of thinking for the government for this entire narrative? We have had some tough sort of lessons learned in the past. What could be the potential red flags which the government should avoid? If this is a dispatch which the policymakers should make note of, and all of you were to give me 2-3 lines of mental modes of thinking, I mean, all of us in a private transaction, if we go for an IPO or a sale, as an entrepreneur, we think about it, the mental mode, how we're building this organization, how we're doing the fundraise. If the government is in the entrepreneur seat right now, how should you think about this? I'll begin with you, Manisha, and then go to the other panelists.
Sure, Srita. I think the most important thing is to show a commitment to the process, set out clear timelines. I think you mentioned, Srita, how do we get the strategic and the long-term financial investors in? I think because these people are in, I live in a global world, they don't have the bandwidth to or the patience to participate in processes which run 2 to 3 years. It's expensive for them. They hire lawyers, they hire accounting firms, bankers. They can't keep it running for 2 to 3 years with no end in sight. So the most important thing is to set stringent timelines, but more importantly, stick to those timelines, right? If the timeline is 6 months, it can spill to 9 months. But beyond that, I think you will lose investor. So I would say, when the government is thinking like an entrepreneur, think about doing this in a time-bound way. Now, when you're thinking about doing this in a time-bound way, it's very important that some of the decision-making, and I'm sure Cyril will talk more about this with regard to contracts, regulation, taxation, you sort that out before you launch the process. Let's think about some of this with your advisors. Of course, some of it the investors will give you input, but a lot of these things, your advisors, given that they talk to investors all the time, can actually resolve for you. So resolve those issues so that you're able to attract a larger pool of investors, and B, give them certainty on a lot of the key issues where otherwise they would spend a lot of time and money understanding those issues. So I think those two for me are the most important things. And thirdly, give assurance to investors that things will not be changed retrospectively. That's really important, right? So I think those two for me are the most important things. But I guess I'll hand over to Santosh and Cyril to comment further.
Yeah, Santosh.
I'd add 2, 3 other things that are important for the government to keep in mind. I think to identify and have clarity on the contracting structure, but as we go along the process, to be able to make it adaptable. I'm just taking from Manisha's kind of comment on that. But as a lawyer and as a person who's been kind of sitting on the wrong side of the table for the government, I think it's important for market to understand that the government will look at things as and when they are required to look at it differently. Courses for courses is something that's critical. The policy document lays the thought process for it, but needs to be followed in practice. I would say a stable and fair regulatory framework for both tariff and disputes are important. We have set the tone for many of these things already in some of the legislations. Some are working well, some are not working so well. If you want to do the scale that we are currently talking about, it's critical that we have not just not just stable and fair the regulatory framework, but also the capacity for it. If you look at the NCLT, for example, recently, it's not a parallel, but just to give you the capacity problems. It took such a long time to get a chairperson in and to have fill up the benches. We can't have a similar setup here, and definitely cannot fill it up with former bureaucrats all the time. So to have that kind of a stable and fair regulatory framework is, I think, very, very critical. The third element I would add would be, to make sure the documents and the way we are looking at this is bankable. I mean, the critical thing for this entire monetization pipeline is actually the ability to attract capital that will invest in. To give you an example, the old NHAI frameworks, for the road concession models, it took almost 10 years for international capital to come into it on the debt side, and 15 for it to go to the market. We can't afford that kind of a lag. So we need this framework, the documentation, to be bankable from an institutional and a market standpoint.
Okay, I come to you now, Mr. Shah. Yeah.
Thanks. Excellent comments from Manisha and Santosh. But I just want to step back one level, and I think the basic answer to your question first is the government needs to get its mindset right on this. I think they have to realize that this is a partnership, and in a partnership, everybody needs to win. If you set up the process in a manner that the private sector can never win, and that they're made to feel guilty about making profit, this is not going to work. it has to be a fair process. PPP में there are three P's, and the last word is partnership. So there's a fundamental difference between a sale process where you say, okay, I've made my disclosure, caveat emptor, देखना है वो देख लो, and then you put your price and bye bye. This is not that model. This is a model where the government has actually made a big virtue out of the fact that I'm not selling. I'm entering into a long-term monetization process with you. We expect you to do something. Why is the private sector going to come in? And why are private financials going to back that entrepreneur? Only if they're going to make money. And if they're not going to make money, then this is doomed to fail. So I think first and foremost, we need to get our mindset right that this has to be a win-win. If the government approaches this with a zero-sum mindset, ये गया. Then three, four specific points I would have, and I think it builds a little bit on what both Santosh and Manisha said. You have to get the process design right. I mean, even if you look at what happened to some of the other privatizations, we got through trial and error, we got the design right after multiple attempts. Now you have all that learning. So पहले से ही just get the design right. Spend some time. Extend 6 महीना ज़्यादा लगना है तो लगने दो. Get your design right. Consult the private sector before you put out something to see what is important. Get all the stakeholders' inputs. But the time invested on getting the original design of the process right is going to save you a lot of time in the end. So as they say, if you want to go far and if you want to go fast, go slowly. So that I think is important to get that aspect. So process design is very important. Second, I think the government needs to also make up its mind in terms of its attitude towards conflict. It is going to have two capacities. One is it's going to be a counterparty in some way, and secondly, it's also going to be a regulator because it's going to regulate the amount of fees and things like that. It has to be very clear that we have to separate these two. You can't be a counterparty and a regulator. We saw what happened in telecom. I think they need to fix this design defect right from the beginning. That where there is a 30-year concession agreement and revenue streams evolving over a period of time, I think they need to unbundle these two capacities. Let the sovereign or the asset owner be one, and let the regulator who looks after public good and public policy be another, preferably an independent regulator who has got credibility. And that is going to be one of the most critical things which a foreign investor is going to look at. They're going to look at two things: independent regulator है, and independent regulator के ऊपर independent judiciary है. So if you have these two, that creates tremendous confidence. So they got to get that structure right. And also, there is these are 20, 30-year contracts, we think. Life is going to change as many times as that period. So the contracts have to be malleable. I think a little bit building on what Santosh said, you can't have very rigid contracts because they break, they become very brittle. For surviving for this term, particularly when you've not sold the asset, is that you need a malleable contract. And some of the best examples of PPP across the world are where you have those. So contracts should last that period, but it should have inbuilt flexibility for fair change. Because if you worked out your original risk allocation correctly, that should be possible. And it shouldn't be that every time then you go for a change, it becomes some big scandal and public interest litigation, and Mint will write one big story on it and all of that. We shouldn't get into that mindset. The fact that in a long-term contract, when risk allocation and when market factors change, there will be change. And you have to adjust in a manner that you get back to the original kind of construct as well. So some of the best long-term projects, infrastructure projects, are built on flexible contracts, not brittle contracts. So I think these 3-4 basic things they have to get right. Additional process design, first mindset that this is a partnership where both sides need to win. Process design and how you get it done. It also goes to Manisha's point on timelines. Malleable contracts, and remove the conflict of interest between owner and regulator. I think I would say these are some of the three or four foundation stones of getting this right.
That's very well put. definitely sort of laying out what the government should do, and most importantly, what the government should not be doing. We spoke about the opportunity, we spoke about the capital interest, we spoke about the role of capital markets, we spoke about the design thinking process, we spoke about the do's and don'ts from the government's perspective. Now, the big question in the room is talking about the valuation. We are seeing across what in the country is unicorn obsession. There's too much capital chasing, too many these technology companies. The term like decacorns are becoming a commentary phenomenon. We are having so many unicorns in India right now. Technology is really at the heart of deal making. I earlier posed this question to the August panel that would we see a similar kind of interest to these assets? And all of you unanimously said we'll see perhaps more because of the variety of capital chasing it. Now, help me understand that how will the government ascertain what the valuation of these assets would be over a long-term horizon when the growth rate of the economy can only be a guessing point at this point? I'll get on to you, Manisha, and then to Mr. Shroff. Yeah.
Sure. I think, valuation is something that is between, what we forget is between the seller and the buyer. So, I mean, there are buyers, they will give you inputs, they go through extensive due diligence, they basically look at what the company has. In a lot of these state-owned companies, there are a lot of hidden assets like real estate, etc., which need to be valued. So I think between the seller and the buyer and their advisors, they can do a comprehensive job on valuing these companies. Some of these companies are listed, and I firmly believe that the listed companies, the value is out there. I think markets are a great way of telling you what the real and true value of the company is. We all may believe that there is some more intrinsic values, but I honestly think that the markets tend to value companies very well. Now, there may be certain assets in companies which the market doesn't value, which are not yielding, like real estate, etc. In which case, as Santosh mentioned, you can think about, probably leasing those assets separately, doing InvITs, REITs, etc. There are enough and more buyers for that. So I think on the listed companies, I'm not so worried because there is a public market benchmark. The private sector, of course, it's much more complicated, and that's where the role of your bankers, advisors, etc., come in. They basically come in, value the company, maybe have some fireside chats with investors informally, and draw up a valuation mode. As I said before, I think, Shrija, there will be enough and more appetite because the tech frenzy that we are seeing is from very specific investors in the private domain. And in the public domain, of course, there's an excitement because there's a whole new sector being created, right? So you're seeing this kind of frenzy. And globally, whether it's FANG, which controls about 20% of S&P, you'll probably see the same thing happening here. I don't think we should worry that the formation of the tech sector will take away from the appetite or impair the valuations just because, oh my God, this doesn't have a tech element to it. If you were to privatize, let's say, a state-owned bank, everyone knows that the way a state-owned bank owns its customer, none of the new age digital fintech companies can. So that's how those companies who are bidding for it will think about it. The distribution network, the branch network, the own your customer that a state-owned bank has, and the undervaluation of these assets will all be reflected when the investor comes in and values these assets. So I think investors understand what they're getting. And in fact, in a lot of ways, as Cyril said, a lot of these new age companies will bid for these companies because today what succeeds is a phygital model, right? So digital is great, but I don't think they have the physical network. When you've seen a Pharmacy or Byju's, what are they doing with the capital they have? They're going and buying hard assets because they know they don't have that, and they know they can't create that at the pace that they need to deliver to the market, the growth that the market is expecting from them. So it will be valued very differently. Physical assets will be valued, the skill set will be valued, the distribution network, the access to customers, all of that will go in. And I strongly believe that, especially today with the kind of liquidity available and the kind of value for physical assets that even new age companies have, you'll see a very strong and robust outcome on valuation.
I would like to bring you in, Mr. Shroff, here, and just taking it further from what Manisha just said, that we are also seeing this phygital model playing out very hugely in the technology and the consumer internet space. I remember, as somebody tracking the private market space for about a decade now, when this entire narrative built out of private capital infusion in loss-making companies, I heard a lot of private equity investors coming and talking to me, oh, this is not going to work out. And now there's definitely FOMO playing out. We see private equity investors investing into large venture-backed companies because nobody wants to miss on the growth, even if it comes on the question of profit or loss making, because there's a long-term horizon. They see this path to profitability somewhere, and these are very, very large outcomes. When you talk about the venture space, there are two buckets of reasoning. One says, oh, it's a venture forth. And the second says that because the outcomes are so bigger, perhaps the capital allocation has to be that much big. So they rationalize this with the outcome being bigger. So the valuation metric, the valuation models do get evolved. It takes a bit of a time when the new space is being built. Now you have this huge space of asset monetization in front of us. What do you think will be the valuation metrics? For public companies, of course, it's sorted and established. In terms of private companies, what do you think? How would the buyers think about the valuation?
So two thoughts here. I think the Niti Aayog, which put out that document, I think is very aware of the challenges on this, and they've sort of put out a couple of options as well, whether it's going to be enterprise value, book value, but in any case, it will go through a process as well. And for each different asset category, I think there will be differences which will arise. But I am seeing a slightly different problem. See, if you really go back and step back into one of the policy motivators for this whole initiative, it is not just about getting a sum of money in the valuation, based on it's not a sale. This is also about developing infrastructure. So take an example. If there is bidder A who puts say 1,000 crores on the table as a lump sum amount, but bidder B puts 800 crores on the table, and he says, I'm going to do A, B, C, D. I'm going to do this. I'm going to bring in technology. I'll do this. I'll improve the quality of the asset. I'll do X, Y, Z. How are you going to compare these two bids? If you compare them only on the basis of 1,000 versus 800, 1,000 wins. But in national interest, B needs to win. And I think you're going to have a lot of this because of the types of assets that are there. So you're going to have a very qualitative element to this as well. It's not just a number, and it's not all in the price. The price, I think, is going to be just one part of it. I think the impact, and I don't know what measurement metrics they will come out with, in terms of how you're going to measure the qualitative impact that this is going to have on the economy is going to be a very important factor as well. And I didn't see anything in terms of the metrics, but that is exactly why they need to get that original design right, of what are they going to look for, what weightages they're going to give, and how that final number will be arrived at. And some of this we are seeing also happening in the IBC processes, and when the creditors committee looks at plans. It's yes, I think value is of course a big part of it, but they look at a bunch of things as well. And we will have to, because these are roads, these are airports, these are pipelines, these are ports and all of that. You can't just go on the basis of value. The wrong bidder may get it if he pays 1 rupee more, and you can't take that risk, and that will become a bigger scandal. You're on mute, Shrija.
Santosh, any thoughts on this?
I agree. I mean, I want to just take 2 minutes on the theme that Mr. Shroff just touched on, saying that I think whilst we are looking at value more than valuation, I think is important. I would kind of try to make that differentiation. Just two more thoughts on it. Just taking off from where Mr. Shroff is. One is I think he touched on it, which is the governance of the assets. I think the importance of identifying the governance model for these assets as the new players come on board, as they make commitments to do certain things. At the end of the day, you are holding in trust public goods and public assets, and I think it's important that you govern them well, that you treat these assets as a national asset, without taking away from the partnership model and the fact that you can make a profit. But it is important that the governance and the treatment of these assets as public assets or as trust assets for the country is done. I think that's very important. So I think the value proposition that you bring. The second is, I think we need to bring an I know that the word I'm going to use is going to be bandied about pretty much across multiple conversations that you have, Shrija. But we need to bring a discussion on intergenerational asset maintenance and overall long-term sustainability as well. How do we get this, and what state do we get this asset back after 40 years? How much better is it when you get it back, and how much longer can it be or serve the country at that point in time? We use it in many different ways, but I think this is an important use of the term. The asset needs to maintain or create that intergenerational value for us. Today, we won't be there 40 years from now when this conversation is happening again. It's important, therefore, that we put in place at least a skeleton, and we can't predict 40 years from now what the world is in, what stage it is in. But we need to put that skeleton in place, or even the system in place, which maintains or keeps this kind of long-term sustainability of these assets and of making them available for the generations to come. I think it's very important to think of that. These are two additional points.
Just one quick point to add to what Santosh makes a very important point. One of the big sources of capital is going to be ESG funds. I think a lot of ESG capital is going to chase these assets, and they are going to be very prescriptive and demanding of what they see, including what the asset looks like 30 years from now. So they are actually going to drive the agenda.
Some very meaningful ideas coming to the fore, and a lot of food for thought for the government and the policy makers really being discussed here in terms of do's and don'ts, policy framework, design thinking, role of capital markets, how you should do test marketing and sounding the valuation metric, and how the emphasis should really be on value and not necessarily the valuation. It's been a very meaningful, insightful conversation. Just coming towards the end of the conversation here, really about the long-term benefits of this policy if implemented well. And I ask you this, that IBC, for instance, really brought about a behavioral change, and one can actually see a difference in the mindset of the promoters. Earlier, people really thought that the best way to go and build a company is to take money from the bank and really forget about it. But the IBC did bring in that behavioral change. Actually, I heard this from promoter while interviewing him. But there's also some juries are out on the road on that one. It's been a mixed bag in terms of how effective it really has been in terms of resolution of assets. Now, this has come by. We have seen many reforms in the past. What should we really must avoid that that the government does not fall flat on its face for this time? I'll begin with you, Mr. Shroff. One long-term benefit and what must avoid.
Let Manisha go first on this one.
Okay.
She can give a market perspective. Manisha, your privilege.
Sure. Shrija, you said one long-term benefit, and what was the second question?
The second was, what should the government really avoid to really fall flat on its face?
I think the long-term benefit is that in a lot of cases, you just have to stop the erosion of capital, right? A lot of these assets have become assets where you're just putting in capital because of all the decision or all the points that the whole panel has said. Basically, capital is not being put to productive use. Return on equity is low. Your shareholders are not getting the kind of returns that they should be getting. And I think the way to maximize it is by all the various options that we discussed, whether it's outright privatization, whether it's a PPP model. I think that is the most important thing, that as a shareholder, basically the government has to think like a businessman and say, I want to maximize value from this asset. I want to sweat this asset, which is the best hands that it can go into, which will maximize value for me, because I have a lot of other priorities. So I think that is the biggest long-term benefit, that stop putting in capital here, put capital into productive uses where we need government capital more, right? Redivert your own capital resources, stop the bleed, get private sector come in, which creates probably more accountability, etc., and basically get these assets to generate better returns. Pitfalls, I think we discussed before, Shrija. I think very important: bankability, contract honorability, timelines, keep the momentum going, show how it's different from before, how we are serious about the business of privatization, how we are willing to make the hard decisions. And I think you will have great outcomes. I hope Air India soon will have a great outcome. And I'm sure a lot of the others too will, just so long as you're able to show that you have that will to make the hard decisions and deliver to the private sector what they want to see in terms of commercial viability.
Okay. Yes, Mr. Shroff.
So I think we did cover some of the ground already in terms of what are some of the key success factors in terms of how to make sure that this policy succeeds. But if I were to single out one particular thing, I think it's the mindset. The government has to approach this with first start with the correct thesis, which I think the government has. They've already said publicly that government has no business being in business, and I mean let them do what the state is required. So that's a great starting point. Now, having said that, now you have this whole bunch of assets which are essentially business assets. So as you migrate them to private hands, run the process properly and run it with a mindset that this is going to be exploited and it is going to be made more efficient, and the private sector is going to make money out of it. Don't make them feel guilty or don't make them feel like crooks. The fact is that there has to be trust. I think the foundation of any great society and any great economy is trust. Not just trust between private parties, but trust also between the state and the private. If this is approached with a mindset of distrust that the private sector is just out there to grab stuff, and then this is going. Koi aayega hi nahi. You're going to have your one-sided swayamvar. Is what I think is going to be the where it is going to sort of end, because they're going to come to people like us and like Manisha and others. Is this bankable? Private capital has many options, both in India and abroad. Why are they going to prefer this option and participate in this great national experiment unless they see some benefit in this? And also and it's not that they're only after money. A lot of private capital also wants to do good. I think with the rise of ESG, purpose has become important as well. So purpose-oriented capital is also there. But again, at the end of the day, they're going to look at the risk profile, and the risk profile has to come out at the right space. So I think it should be a more equal conversation between the state and the private sector. If it is like this, then you have a problem.
Okay.
But if you get this right, this is transformational. We'll be a very different country.
Okay. And I think my last question, and if we're to sort of think about this, that if government were to think itself like an entrepreneur, and we are seeing so many good companies being built, which are attracting so much capital, providing so much employment, and if they were to perhaps draw a leaf out of the playbook from some of these young generation entrepreneurs as to how they think about this national experiment, what could that really be?
Let Santosh take it.
I think what is it's not that. So if you look at the young entrepreneurs and the young companies, it's not just the fact that they're doing technology or using technology that is interesting. It's the fact as to how they go about doing it. The algorithm, I think the methodology is important. So I think if I were to take a leaf out of young companies' books for the government to do, I think it's getting your algo right. I mean, taking from Mr. Shroff's point on getting the idea, the design thinking, the nimbleness, all of these things, if you put it together, it forms, an equation of some sort that gives you the left side of the picture. And then you need to equate it to the right side. I think getting that algorithm or understanding how you put that together from these guys is important. You can use it in technology. You can use it in food delivery businesses. You can use it in running an infrastructure asset. It's the methodology and the thought process that goes beyond that. I think that's what we would want to learn. We would want the government to learn.
Just talking about some specific transactions which are doing the rounds right now, and perhaps I will get you in Manisha in here. For instance, the Air India divestment, which is so much in the news. The airline sector has been reeling with losses of a good chunk of time, and all of us know it. In fact, there's a good saying that the worst business to be in is the airlines business. It's like about $4 billion, the entire losses. At the same time, we have someone like Rakesh Jhunjhunwala, Akasa, is gaining some stride in the sector. How successful do you really think that the government's divestment of Air India really be? How will that really pan out, the entire story?
Question for whom?
Manisha.
Okay. So look, I think, while Rakesh Jhunjhunwala is setting up this new airline, I don't think we're comparing like for like. I think, Srija, what the government should be really proud of is the assets they're selling. What Air India has in terms of just the pilots, the staff, the landing slots, the aircraft is unparalleled, right? It's been stuck with this issues on debt, leverage, etc., which now are getting resolved. You are actually talking about a business which is a market dominant leader, right? That's what you're selling. So, to your earlier point on how do you compare with the tech companies are startups. They're basically exploring new areas, new sectors. What these public sector state-owned companies have is a history of 100 years with a lot of hidden assets in them, which will be so meaningful. I think I keep going back to the same point that it's so difficult to create greenfield assets. And what this state-owned company is giving you is it's giving you a 100-year fast forward, which when leveraged well in the hands of the private sector can become a really meaningful player. Right? In the airline sector today, what do we have? We have Indigo, we have Air India, and we have Vistara to a limited extent. Air India in a private sector, with the kind of nimble decision making that a private sector will give it, and the kind of head start it has on the assets, on the slots, etc., can be a game changer. Why is Dubai a center, a center for the whole world? Why do we all take flights out of Dubai to go to the world? India should be. We have world-class airports, as Cyril mentioned. We now need to have world-class airlines so that people think of India as the hub to the West. Everyone should fly out of India. They're geographically better located, and that's really what I think we should be proud of. We're not competing with these digital new age assets, which bring a very different proposition to the table, which the market is excited about. We are bringing very different world-class assets which are undervalued, and when mined correctly with the right contracts, can be a game changer. So I think that's how we need to think about it.
So they're great assets. We need capital, and we need perhaps great turn on capability. And that is where technology comes in. And when that happens, that will be the perfect meeting of minds and will be the great game changer. But we really need the government to have the correct mindset for it and focus perhaps on the value and not so much on the valuation, get its contracting, design thinking, and long-term bankability of the contracts correct. So the government is really at the heart of all of it. And I think it's at a very interesting seat, at the driver's seat as a regulator and also the seller, what Mr. Shaw pointed out. So is there a playbook that we have seen in the other economies playing out for some of these asset monetization drives, where the government had to really work on this very critical slugfest between having to attract investors and also to play the role of a regulator?
If I can,
Yeah.
So I don't think there is a standard playbook which is a copy paste from anywhere. I think you have to construct your own one. There is a lot of good stuff in the UK, the Thatcher reforms, then in the US, the Eisenhower stuff, but also a lot of our own experience. I mean, we have been, as a nation, we've been experimenting with this for a while, whether it's the IPCLs or the Hindustan Zinc and more recently some of the other ones. So there are a lot of lessons. I think with some humility, if somebody from the policy establishment were to just sit and take note of all of this, of what has worked and what has not. And I would give government credit. I've seen them actually change their mindset across. I mean, look at even Air India, of their original starting position and now. They have shown that flexibility. So we should not lose the benefit of these learnings. So I think we'll have to construct a new playbook which is inspired by lessons of the past. The worst thing we can do is ignore those lessons. It's always said that it's all in the history books. Go and check it. So if we just approach that history with a little humility, we'll find that answer. But let's not look for googling a nice manual of how to privatize or how to monetize. It doesn't exist.
Okay, we spoke about quite a few things, developing your own playbook. My last question, this panel, we're going to rapid fire, is none of you really spoke about perhaps crony capitalism creeping in. Will there be an issue where certain corporations will be favored out of crony capitalism? I mean, we have seen these instances playing out in various reforms in the past, time and again. How can the government really be rigid to the point of avoiding this? And how can we do that? Yeah. Who wants to take a stab at this?
Santosh?
Sure. I think the sheer scale, I think that's the number one point I would make on this. Two things. One is the sheer scale of this. It's so huge that there is a necessity for a breath of fresh air from the capital side, and there is a necessity for international capital in its various forms to come in, be it as a partner, be it as an investor, be it as a strategic themselves. The sheer scale of the money that is protect us against this. The second point I would make is, I think, getting the design right. I think it is important to get the design right, and I think that's going to play an extremely important part. Making sure that we get asked the right questions, we have a partner, and we attribute the right value to this.
Okay, it's time for some quick rapid fire. But before we get on to that, one key message for the government from all of you as a closing remark to the policy makers, one dispatch, quick 1-2 sentences each. I'll go on the panel, go to you, Mr. Shroff, then Manisha, and then Santosh. Yes.
I think a lot has been said already, but if there is one message is that talk to the stakeholders before you finalize anything. Just listen.
Okay, just listen. What about you, Manisha?
I think flexibility, it's actually linked to Cyril's point that talk to the stakeholders, and if you need to change gears somewhere in the process, then do it. And I think Air India, as Cyril said, has been a great example that they're doing it, and they need to stick to that track that, look, you need to be flexible, you need to hear the other side, because it has to be a win-win for both sides. And if there's some things that you haven't thought of in advance, but is very important to the private sector, then show flexibility, adapt those things, and end game has to be to maximize value and find a good home for the asset. And to do that, if you have to show game changing in the middle of the process, just be open.
Okay, Santosh.
Sorry, can you hear me now?
Yes.
Okay. Yeah, I was going to say listen, actually. I think that conversations are actually very important. And I think to have those conversations effectively, I think there has been a lot of that identified and done over the last few years. I think the mindset has changed, but still, nonetheless, I think the most important lesson is listen.
But these adjectives, listening properly to your stakeholders continuously, be ready to be flexible, adaptability, is something which I hear so much in the context of technology conversations and investing parlance. Now the government is getting the driver's seat, and let's see how flexible and adept they are to these changes. It's time for some quick rapid fire. I'll bring on to you, Manisha, the first. How is 2021 for you as deal making?
Strong.
Okay. Is it why are the investors still not using the B word?
Why are investors not using the
B word, the bubble word?
Can't hear you, sorry.
Bubble.
The bubble word.
What do you? Yeah.
I don't think investors are using the bubble word because they are seeing the stupendous amount of growth. So I think the way to validate the capital that's coming into the country is by basically growing into these business models. And that's why the razor focus in the next few years for government, for private sector, and for all other constituents has to be to keep focusing in growth and valuation that the investors are giving you and saying, yes, this was justified in hindsight.
Okay. In your entire investment banking career till now, do you think 2021-20 has been the busiest for you? The most exciting, the COVID-induced growth?
Well, I think it has been very exciting. And the reason it's exciting is because if you had spoken to me in February 2020, Srija, I would have said, I am extremely worried. We are not going to be able to do business in this virtual format where you can't meet your team. We are basically a business about services. So how are we going to generate any revenues by not meeting clients, by not meeting constituent lawyers? And so I think that's what has surprised us, that we have all adapted to this virtual format so beautifully, and business has gone on as usual.
Okay. And if you were to devise a pitch for the government, an elevator pitch for the government, 2 minutes, how will that look like?
So I think it will first premise on India, growth opportunity, the size of the country, the size of the consumer population, the kind of dollar millionaires that have been created, the strong consumer market. You're not going to get this anywhere. And most importantly, what the government can assure people is certainty and regulation. Right? That only the government can do. That look, this is a country where you won't have regulation flip-flop, you won't have what happened in China recently. You have the market, you have the growth. So where else can you go? You cannot get this size and scale anywhere else today than in India. China and US have already gone to a certain level. The other countries are too small. Europe is just not growing. So I think this is the sweet spot in terms of growth, in terms of size, and in terms of regulatory certainty.
Okay, Santosh, the same question I have for you. If you were to devise the pitch for the government, elevator pitch for the government, let's see whose pitch is stronger, yours or Manisha's. What would that be?
Thank God I don't compete
Um, I would go with creating value for an extremely large population. I think it's the capability for a young population growing more savvy, understanding their needs. So any good corporation would have the capability, or any good investor would have the capability to leverage this young population and leverage the capability of their understanding to bring value to them, to bring quality assets to them, and ultimately actually reduce the effective price of what we are doing for many of these assets without compromising on the partnership. So I think this is probably what we would be able to do.
Okay, I come to you now, Mr. Shroff. In your entire career till now, how do you think 2021, this entire pandemic-induced growth period, will go down in the history for deal making?
So it has been one of the most interesting phases of all our respective careers. It has surprised us in many ways. I think our own anti-fragility has surprised us all. It has surprised me in terms of my own view of the world in March, April 2020, and now is vastly different. So I think we underestimate ourselves quite often, and I think we made the mistake of thinking that this is like 2008. It wasn't, because the markets I think were open, and I think we underestimated what kind of human ingenuity can do. I mean, look at this. So in that sense, it has been very interesting. From a deal point of view, it has been one of the busiest phases in our career, probably the busiest. But it's not just because of how the reaction to the pandemic. I think there was a lot of pent-up demand, and how technology had moved, and how the millennial demand had moved. So all of these created the kind of perfect storm for the deal environment, and it's not over yet. So I don't think it's a bubble. I think this is going to continue for a while. Of course, there will be peaks and valleys, and all of that will happen. But I think this is going to be good for a bit. And I think the third thing is, I think it has allowed us all to reinvent ourselves in very different, unpredictable ways for the better. I think it's been a fascinating period.
Okay, I would sort of ended up with you, Manisha, just ending with the lady on the panel. And very interesting observation, Mr. Shroff said that all of us discovered our anti-fragility. What was that moment in, perhaps you were in office and you were thinking that you discovered yourselves truly anti-fragile in this entire 1.5 years that went behind us?
I think the resilience that I was able to build up in my team, the faith and conviction that we may have gone into a virtual format, but we still can make a case to the client. You said give the elevator pitches. I think that's what, for me, because it's as I said before, Shrita, our business is really a personal business where you go in and talk very confidentially, strategic thoughts about mergers, acquisitions, divestments. And I think the fact that we were able to do that and win a client's trust in a virtual format and execute transactions, I think for my team was the biggest anti-fragility moment, and a restoration of faith that all the years that we've spent in this business means something, and is yielding results.
Establishing trust in a synthetic environment can be such nightmarish for everybody, and I just can't begin to explain what it can be for lawyers. be negotiating contracts in a virtual environment. But that's really what it is about, to discover how anti-fragile we are and emerge stronger in the face of adversity. And thank you for such a meaningful discussion, Mr. Shroff, Santosh, and Manish on a Saturday afternoon. And here's wishing to audiences best of luck. Till the time I see you next, goodbye and good luck. And thank you so much for your time and energy to this. Very lovely conversation. Thank you. Thanks.
Thank you.
Bye-bye.
Bye-bye.
Thanks.